So kind of think about, remember the butterfly had, you were short the body and you were long the wings. The condor, you're kind of like short outside the body and long even more wings. So like that wingspan is wider and you have more room for that stock to move around. That's why it's kind of called the condor. It's got bigger wings. And once again, it generates premium income with a defined risk and reward profile, which we love as traders because we always love managing our risk. All right, so now let's construct the condor. So we're going to sell one out of the money call, buy a further out of the money call against it, basically putting on that bear call credit spread. We're also going to sell an out of the money put and buy a further out of the money put against it, the bear put credits or the bull put credit spread. We're going to combine those two. And now what we're going to have is the iron condor. Strikes are going to be equal distance apart. And when we net this out, it's always going to result in a credit, which is the premium amount that we take in when we sell two spreads. Now we're selling two spreads. We're going to take in double the premium. That is our overall maximum profit potential. All right, so OICX is trading 150. Now we're not bullish, we're not bearish. We decided that we want to put on an iron condor, so we look out on our options chain. We're going to sell the 145, 140 put spread and the 155, 160 call credit spread. Using those examples, remember we sold the call spread for 160, we sold the put spread for 170. Those two premiums add up to $3.30. That is ours to keep. That $330 goes into our pocket. That's the most we can make on this position. The maximum loss, once again, it is the difference in strikes. Since both spreads have a difference in strike of $5, we take $5 minus this maximum credit that we took in of $330. Our maximum loss is $170. $5 minus $130 is $170. Once again, as margin, we're going to have to keep at least 170 or 170 per spread in our brokerage account to guarantee against the position going against us. If the position goes against us and the stock makes a big move up or a big move down, the most we can lose is 170 or 170 per spread. Now we have two break-evens. Now the break-even is, remember, it is our short on the upside is our short 155 call plus the 330 we took in. That gets us, that's how we get to 158.30. We also have to, we have a downside break-even, the 145 put minus 330. That gets us to 141.70. So any place between 141.70 and 158.30, we have profit potential. Okay, we have a range of prices that the stock can trade between for us to make money. Ideally, we would love the stock to finish somewhere between both our short strikes, the 155 below 155 and above 145. If the stock finished right at 150 at expiration, all the options would expire worthless, and we'd end up keeping the full 330 credit that we initiated the spread for. Once again, excluding commissions.